Ladies and gentlemen, welcome to Only Trade to Win. Today is Saturday, April the 6th, 2024, 8:30 a.m. New York time. This was a super volatile week, especially Thursday and Friday. And this volatility is caused by speculations on whether or not the Fed will cut the rate. So in order for us to get a better idea, let's take a look at inflation, gold prices, yield curve, and current price levels of indexes and stocks, and try to get an idea of what we are expecting to happen and come up with a plan on what to do if our plan does not meet the reality. First of all, we are in an extremely volatile market. Here is Monday of last week. Here is Thursday of last week. Down 140 points on the S&P, and that's more than 2.5%. Now on Friday we get jobs report, which come in a lot better than expected, and we make up more than half of what the S&P lost the day before. So let's go one more time. From the top, we were down about 2.2%, and at the closing of Friday, we are down just 1%. One thing I wanted to point out is that whether or not the Fed will cut the rate and inflation right now have nothing to do with one another, because we're in elections year and we all know that inflation is not under control. Let's go and look at the price of gold, and I'll explain you what I mean. Here is the big picture on the price of gold. Right here, we're looking at year 2011. Right here are the last 2 months. First, I'm going to show you how long gold spent in the same price range, so you get the perspective of what is occurring right now. If we look back here, this is August of 2011, and here back in November of 2023, gold traded at the same level as it traded back in 2011, or almost 13 years ago. In that 13-year period, after peaking at this level, gold sold off 45%, and it took about 10 years to get back right here to where we are. We were still at the same level in November, almost 12 years from the top. Again, in the past 12 years until November of last year, nothing happened with the gold price except it lost about 50% of its value, and the price slowly climbed all the way up to where it is right now. When we made it into December, when the Federal Reserve started releasing information that there may be rate cuts, here's what happened to the price of gold. The price that could not break away from the range it spent 13 years. Finally, after the statements that there may be rate cuts, let's take our favorite measuring tool, is up 17%. And the real move actually came in the last March and the beginning of April. I think it's worth going down to weekly to see that we really made this move from here, which was March 4th. So this whole gain here, last 30 days, boom. And basically what the Wall Street is seeing is that regardless of what's going on with the inflation data, there is some pressure on the Fed to cut rates. Everyone is expecting the Fed to cut rates. So our first red flag is we're seeing that the gold price is not only rising, it's actually breaking out of a huge consolidation range, and it is running to all-time highs, suggesting that inflation is not under control. And the fact that the Fed raised the interest rates to 22-year high, it was not able to do anything about inflation. Now, let's quickly talk about the yield curve. Basically, yield curve says that if the time increases, the percentage that investors would like to get back for the money that they invest goes up with the time for the risk that they're taking. And normal yield curve would look like this. So 1 year from today should cost you less than, let's say, if this was 2 years, then borrowing for 2 years, because there is a time period. And during that time period, a lot of things can happen, and investors worry that things may deteriorate, so they're asking for more in return. And that is called normal yield. Now, the other thing that can occur is that when investors worry about short term, they start demanding higher yields for short term, and then it drops off. So an inverted yield, and let's make it different color, looks like this. Again, today, investors are asking higher rates of return for the risk that they're taking, because they're expecting short-term economy will not do as well as the long-term, and for that they want premium for the risk that they're taking. One of the best places to find information is the U.S. governmental agencies like the Department of Treasury, which publishes the rate. Here is the date that we're looking at right here. If you look up here, it says 1 month. Current rate right now is 0.47%. Now, if we go to the right, we see that for the next month, it's increasing, but then it starts dropping off. And at 1 year, 0.05%. So in other words, if somebody was borrowing money monthly, pay a rate of return which would 0.47% annual, and if somebody just went out and borrowed money for the whole year, they would only pay 0.05%. And you can see the numbers are going up. We're going 2 year, 3 year, 5 year, 7 year, and down below the rates are dropping off until we get in a 20 year, but up 10 years. This is what we call an inverted yield curve, and it shows that short-term risk in the market is greater than the long-term risk. And this is what it looks like. Again, 4.9% for 1 month, and as we went further down the line in terms of time to the right, we got down to 5.05%. So we look, gold prices are going pretty much to the moon. And after 12 years of doing nothing, the price of gold finally broke out, which is great for gold investors. But again, gold is a real asset. Gold is going up. It means people are buying it because they want to protect themselves. Inflation. If we have inflation, then the Federal Reserve raises the rates, because what it does, and if it raises the rates instead of the anticipation of the market, which is cutting it, I'm not sure what's going to happen. We can see that last week, just the idea of interest rate cut not happening was able to send futures down 140% or 2.5%. So that's 2 red flags that we have. Now let's jump into our price levels and really quickly look at the stocks that we follow to get an idea what happened this past. As always, I went ahead and updated the prices just for this past week. I know it's only 1 week. It was a huge week, and we can see NVIDIA pulled back a little bit. Meta had a phenomenal week regardless of what happened to general market. You know, our comeback champion NVIDIA is up 82%. Meta 37%, and considering what Meta did since September of 2021, dropping more than 75% and then rallying straight back, practically no pullbacks, almost 500%. This stock is amazing. And again, even though it'd be hard to challenge the king of AI chips, think Meta has a good chance. Apple is sitting at its critical area. Now, if you have a subscription on TradingView, right here you can add this button and compare it, let's say, to the S&P 500 and the Nasdaq. This is a daily picture of Nasdaq. I'd like to go to the point where we made this bottom in 2021. You see that both orange, the S&P, and the cyan Nasdaq are way below Apple. And if we look at Apple, Apple made all-time highs before the market did last year. So it was the leading stock in the whole rally. As the S&P 500 and the Dow were making its high up till last week, all-time highs until the last. Apple stalled here in December, January, right here. So it made a double top. It traded a little bit above the previous high that was set in July and failed from there on, while the general markets continued to making all-time highs. And the reason I'm saying that is sitting at a critical area is because right here was the low after which the stock was able to bounce and make its all-time highs. It was marginal, but regardless of that fact, it did make it. This area represents a strong support. If you look at it here, 1, 2, 3, 4, and then we're sitting here 1, 2, 3, 4, 5 weeks, we're hammering this area trying to break down. And if Apple breaks down, let's draw it together. It would look like this. Here is your double top, or the M, whatever you want to call it. And if that happens, then all the guys who are trading off the pictures, the pure technical guys, will look. Here's our area number 1. Here is our area number 2, and the question mark is if we're going to go down there and test it. But the thing is that if you look at the general market, it's making its all-time highs, and the market leader like Apple is not going with it, cannot last long. So the jury is out. This is a big stock to watch. As always, only this time we're watching if it can hold this support area or if it's going to break down. From this whole list, Tesla continues to be the weakest stock, making another monthly low for the year, now down 33%. And if we look at the Tesla, This is from our previous show. Look at the level that it's coming into. This here is one of the lows from which the stock bounced into 300s. What we know is that when Tesla came into this area last time, and I will go a little bit lower right here, like this, it went up 100%. Here is what it looks like when we look at it closer. Again, making this low and rallying 100%. Now selling at exactly the same area. We look at pictures again. Here we go. Here's our double top. In this case, it's a triple top. One bye-bye. Tesla, like Apple, is also in a really critical area. And if it breaks down here, we're looking close to par. So, wow. I am 100% positive that we have another exciting week ahead of us. This market is super volatile. This market is definitely not for beginners. And if you're starting, make sure you're trading the smallest size that you can trade. Maybe one share of Tesla, maybe one share of NVIDIA, maybe one share of SMCI. If you're trading futures, maybe one contract, micro contract. You will have to deal with this. This is the hourly picture of the S&P micro futures. Look at these moves, 50 points, 112 points, 80 points. These are hourly, and whoever tries to trade intraday, finding a good spot becomes extremely, extremely valuable. And that comes with practice and knowledge. Here is one, for example. Here is two. Here is three. There are a lot of them. And the only way that you can get good at this is just by sitting and flipping through a lot of different charts and trying to come up with something and saying, hey, look, I am seeing here that we see double bottom. Bottom one, bottom two, we go. And in a strong market like we are, this is actually one of the best strategies to trade. And if you're not familiar with it, I'm sure there are a lot of videos on the internet that talk about it, but here's one, here's two. It's everywhere. The opportunities are everywhere. You know what you're doing. Again, the market is extremely volatile. If you're just starting out, please take care. And until I see you next time, navigate with and have a great weekend, everyone. Bye-bye.